In this video, I'm going to talk about some annuity benefit options. So we have kind of two broad categories here. We have the single life annuity and the joint and survivor life annuities. So first, under single life annuity, we have several different options or several different ways of structuring this. The first is going to be the straight or pure life annuities. This is one in which we have one life that is linked to the annuity. And basically, it is a pure life annuity, which means the company pays out the specified payment during that particular person's lifetime. And basically, when the person dies, payment cease, that's it. So there is a high mortality risk here. And what that means is if the person pays out $500,000 of their retirement savings to buy a straight or pure life annuity contract, sign all the paperwork, everything goes into force, and then a week later dies tragically in a car accident, that's it. The $500,000 is gone. That's it. Okay. And so the mortality risk is large. So if you die early, then you got kind of nothing out of that. Now, there are a couple of different ways that could be modified to ensure that there's still some benefit that would occur even if somebody died prematurely, for instance. And one of those would be the installment refund annuities, which is still a single life annuity. And basically what this does is if the person, the annuitant, dies, then basically payouts continue after death up to a point. So basically until the sort of the full amount essentially has been paid out, then basically the payouts will continue. So that would happen in sort of in installments, hence the installment refund annuity terminology. Another way that could be done would be a cash refund annuity. And for cash refund annuities, what happens is whatever the remaining balance is that had not been paid out, basically is paid out in a lump sum in cash to whoever the listed beneficiaries were. Another way that, or another type of single life annuity would be a term certain annuity. So for a term certain annuity would be one in which basically it's an annuity, but it only lasts for a limited period of time. So maybe a 20-year annuity. And I've discussed this kind of briefly in a prior video, but if you had somebody who was 65, they bought an annuity for 20 years at age 65, and they happen to live to age 95, well, when they hit age 85, that's 20 years after when they bought the annuity stops paying. And that's kind of the end of the story. And so that starts to introduce more of that superannuation risk I discussed previously, which is basically that risk that you outlive your money. So that's something to be mindful of if you have a term certain annuity. Now, another possibility was the joint and survivor life annuities category. So in this category, there are a couple different ways that this can be done, but the basic idea here is that the payments that are made are linked to the lives of two or more annuitants. And some sort of payment is going to occur until the last annuitant is dead. So an example of this would be if a husband and wife basically purchased a joint and survivor life annuity. Basically, what that's going to mean is that when one spouse dies, statistically speaking, it's more likely to be the husband who would die first. So if the husband dies first, then the wife would continue to receive annuity payments at some level until she dies. Now, there are a couple different ways that could be done. And one of them is a 100% joint survivor annuity. And in this one, basically what happens is the annuity is structured such that the husband and wife are receiving the annuity payments. If the husband dies, the wife continues to receive 100% of that annuity payment until she dies. A 75% joint and survivor annuity would be one in which the husband and wife rely, they annuitize the money that they had set aside for that. Progress a few years down the road, the husband dies, and at that point, the wife continues to receive a benefit, but it's 75% of the benefit the husband and wife are receiving together. And the thought there would be that basically the wife alone would not have as high living expenses as the husband and wife together. The thing to be careful about with something like that would be cautious about assuming just how much those costs are going to go down. or else you might wind up creating a situation in which if you have an annuity that pays too little, or you assume the costs are going to drop too much, maybe it makes it difficult for the surviving spouse, the wife in the example that I just used, to retain the home that they've lived in, or something like that, to maintain a standard of living. So something to be thoughtful about there. Now, in some cases, within qualified defined benefit retirement plans, they can have annuities sometimes within those retirement plans. And generally what's required is that it'd be at least a 50% joint and survivor annuity. And so basically what that would mean is you're required basically to have like 50% that goes to these surviving spouse. So at least the 50% of the surviving spouse. You could increase it to have more. That would typically come at a higher cost. But that's kind of the idea. There may be some possibilities to reduce that amount, but it might have to come with the actual written consent of the spouse to the person who is working for the place with that particular retirement plan. So it might be possible, but they might actually have to consent in writing to actually not doing that. And that does bring up an interesting little note, just in sort of in passing. If you have any kind of beneficiaries or anything like that listed through your employer, that's something to very carefully make sure you update that appropriately, because if you don't, you can have some rather unintended consequences. I remember hearing a story from a company that was providing retirement planning or retirement services for an employer that I worked for at the time. And they were talking about a situation in which a gentleman had worked for an entity and listed his wife as the beneficiary on, I believe, his retirement accounts. And then they got divorced and he remarried, and then he died. And he forgot prior to death to change who the listed beneficiary was. And so the first wife was the listed beneficiary and therefore received the payout, which was probably not the desired outcome. But that was just the nature of the situation, because that was who he had listed as the beneficiary. So something to be thoughtful about if you are dealing with employer benefits and things like that, or just kind of any kind of insurance policies or anything like that. Make sure that you are mindful about updating who beneficiaries might be and so forth. Okay. So hopefully that gives you sort of an idea about kind of how annuity benefit options can be sort of structured as it relates to kind of a single life annuity or a joint survivor kind of scenario. Thank you for watching and have a great day.